Most investors know the S&P 500 as the benchmark of American stocks, but very few understand how the index is actually constructed, how companies enter it, how weights shift, how dividends compound, and why an ETF like VOO can track it with near perfect precision. In the next few minutes, you'll see what VOO actually represents beneath the surface and why its structure matters far more than most investors realize. Here's what we're going to be breaking down: the structure of the S&P 500 and how companies enter, exit, and shift inside, the mechanics that let VOO mirror the index with institutional precision, and the forces, cash flows, rebalancing, leadership cycles, and sector weight that drive long-term returns. So the VOO is the Vanguard S&P 500 ETF. Its purpose is straightforward: track the S&P 500 index with precision and efficiency. Three characteristics define VOO. It's passive, it doesn't attempt to outperform the market, it's rules-based, it mirrors the index through a transparent mechanical process, and it's broadly diversified. The index represents roughly 80% of total US equity market capitalization. When you hold VOO, you hold a single position that captures the core of the US large cap market. The S&P 500 is often described as the 500 largest companies in America, but that description is not accurate. It's not an automatic list of big corporations. It's a selectively constructed index maintained by the S&P Index Committee. The index is designed to represent the US large cap market, not simply the companies with the highest market value. The committee evaluates candidates for size, liquidity, profitability, and sector balance. Its mandate is to keep the index stable, diversified, and reflective of the broader US economy. This disciplined methodology is what gives VOO its reliability and long-term consistency. Most investors don't know how companies join the S&P 500 or what gets them removed. This selection process is one of the core strengths behind VOO. A company must meet several requirements before it enters the index: market capitalization above the committee's minimum threshold, sufficient liquidity and trading volume, positive earnings on the recent quarters, US domiciled and listed on a US exchange, a public float above the required percentage, and a role that maintains appropriate sector representation within the index. A company can be widely known and still not qualify until these conditions are met. Companies are removed when they fall below size or liquidity thresholds, are acquired or merged, change domicile, or no longer meet profitability or sector representation criteria. Changes are not frequent, but when they occur, every fund that tracks the S&P 500, including VOO, adjusts its holdings immediately. These index changes often generate heavy trading activity because ETFs must rebalance on the effective date. This rules-based turnover is what keeps VOO aligned with the modern US large cap market. VOO uses market capitalization weighting. Companies with larger total market value naturally carry more influence in the ETF. For example, if the index is trading near 6,600 and the company has a 6% weight, it drives roughly 6% of VOO's day-to-day movement. Two effects follow from this structure. First, VOO adjusts automatically as market leadership changes. When a company grows, its weight increases. When it weakens, its weight declines. Second, there's no prediction or stock picking. The weights rise and fall strictly through market performance. This keeps VOO aligned with the true economic footprint of the US large cap market. The S&P 500 also uses float adjusted market capitalization. Only shares available to the public count towards index weight. Shares that are excluded include insider holdings, government held shares, restricted stock, founder controlled shares, and employee grant shares that have not yet vested or become tradable. Float adjustment ensures the index reflects the tradable portion of each company, not the theoretical total ownership on paper. VOO inherits this precision automatically because it tracks the index exactly as it's constructed. The S&P 500 is reviewed on a regular schedule. Rebalancing keeps the index aligned with sector composition, liquidity standards, and the financial health of its constituents. Rebalancing includes adding companies that newly qualify, removing companies that no longer meet the criteria, adjusting weights as market capitalizations shift, and updating the index to reflect the current structure of the US economy. VOO adjusts in parallel. The ETF stays aligned with the index automatically, with no action required from the investor. VOO mirrors the sector composition of the US large cap market. The largest sectors commonly include information technology, healthcare, financials, consumer discretionary, and industrials. These weights evolve naturally as industries grow or contract. There are no sector rotations, no tactical forecasts, and no manager influence. VOO simply scales with the structure of the US economy. Because VOO is market cap weighted, its largest holdings have a greater influence on the performance than smaller companies. This reflects real economic structure. Large firms shape markets more directly. Their earnings move supply chains. Their results influence sentiment. and they represent core components of US economic output. Market leadership also shifts with time. Decades ago, leadership came from energy and manufacturing. Today, it comes from technology and communication services. VOO adjusts automatically as that leadership rotates. Most companies in the S&P 500 pay dividends. VOO collects those dividends and distributes them to shareholders on a quarterly schedule. Dividends are a meaningful driver of long-term performance. They form the difference between price return, which measures only the index level, and total return, which includes price appreciation, reinvested dividends, and the compounding of those cash flows over time. Across multiple decades, the gap between price return and total return has been substantial. Reinvested dividends historically account for a large share of the market's real growth. Dividends matter inside VOO for several reasons. They provide consistent cash flow, they help offset periods of weaker price movement, they accumulate into new shares when reinvested, and they reinforce long-term return stability. Professionals focus on total return, not price alone, because compounding dividends smooth the long-term behavior of equity exposure. VOO is built on that principle: broad market exposure, stable dividends, and passive compounding. VOO tracks the S&P 500 using a method called full replication. It holds every company in the index in nearly identical proportions and adjusts its positions whenever the index is updated. This approach delivers several advantages. It minimizes tracking error, it produces predictable behavior, it avoids manager-driven decisions, it provides full transparency into holdings, and it keeps the ETF aligned with the index's performance at all times. This level of precision is one reason institutional investors use VOO in long-term portfolio models. The mechanism that keeps VOO's market price aligned with its net asset value is the creation and redemption process. Authorized participants, large institutional firms, can deliver a basket of the underlying S&P 500 stocks to create new VOO shares, or redeem VOO shares and receive the underlying stocks in return. This mechanism keeps VOO from drifting away from its intrinsic value. It also allows the ETF to scale with investor demand without distorting the market. VOO benefits from two layers of liquidity: secondary market liquidity, the daily trading activity on the exchange; primary market liquidity, the ability of institutions to create or redeem shares when demand shifts. Because the S&P 500 components are among the most liquid securities in the world, VOO maintains tight bid-ask spreads, minimal slippage, and stable execution even during volatility. For both beginners and professionals, this level of structural stability is a major advantage. Tracking error is a small difference between VOO's return and the return on the S&P 500 itself. It typically comes from the ETF's expense ratio, execution timing, corporate actions, temporary cash balances between dividend payments, and index reconstitution events. VOO keeps tracking error extremely low because of Vanguard's scale, transparency, and full replication approach. Holding VOO means accepting the same risks that apply to the US large cap equity market. These include market volatility, economic slowdowns, earnings declines, interest rate shifts, sector concentration in leading industries, and occasional geopolitical shocks. The S&P 500 has experienced significant drawdowns during recessions. VOO mirrors those moves exactly. But over long periods, the index has historically recovered and advanced as corporate earnings, productivity, and innovation push the US economy forward. For professionals, VOO provides diversified US equity exposure, minimal tracking error, transparent index methodology, low cost, deep liquidity, and highly predictable long-term behavior. For beginners, VOO removes complexity. There's no stock picking, no sector rotation, and no need to anticipate earning cycles or macro events. A single position provides broad exposure to the US market. VOO is often the foundation of a portfolio. It can be paired with cash, treasuries, international equity, or smaller cap exposure. Its structure is simple, scalable, and durable. Everything inside VOO follows a defined rule set: float adjusted weights, committee oversight, schedule rebalancing, and dividend integration. But here's what most investors never recognize: the index does not stand still. Companies enter and exit, weights shift as market leadership changes, sectors expand and contract, corporate actions reshape the composition. Each of these adjustments quietly alters the long-term return profile of the ETF. Continue here, it builds directly on this video.